The Dow just hit a record high. The Nasdaq fell on the same day. That kind of split does not happen by accident, and what's behind it tells you a lot about where markets stand right now. Wednesday's session came down to two things: a weaker-than-expected jobs report and a sharp drop in Tesla shares. Together, they pulled growth-oriented stocks lower while pushing more traditional names higher. The result was a divided market, the Dow climbing to a fresh all-time high, the Nasdaq sliding in the opposite direction. Start with the jobs data. The report came in softer than analysts had forecast. That kind of miss tends to pull markets in two directions at once. On one hand, weak hiring raises concern about slowing economic growth, and that worry hits high-growth, high-valuation stocks hard. On the other hand, a cooling labor market gives the Federal Reserve more reason to cut interest rates sooner. Lower rates make future corporate earnings worth more in today's dollars, which can support steadier blue-chip companies even as tech names sell off. That tension is exactly what played out Wednesday. Then there was Tesla. Shares fell roughly 7% in the session, a move large enough to drag the Nasdaq lower on its own. Tesla carries significant weight in the index, meaning a sharp single-day decline in that one stock can pull the whole benchmark down, even when most other names are holding steady. When a stock that size moves that fast, it does not just reflect company-specific news, it amplifies whatever mood is already running through the market. Step back, and the picture gets clearer. What happened Wednesday fits a broader pattern that has been building all year. Investors have been quietly reassessing how much they are willing to pay for high-growth companies as interest rate expectations shift. When bond yields move on economic news, as they did this week, the recalibration tends to hit technology and growth stocks hardest. More traditional industrial and financial names, the kind that dominate the Dow, can hold their ground or even advance in that environment. The Federal Reserve is the thread running through all of this. Policymakers have said repeatedly they want convincing evidence that both the labor market and inflation are cooling before they move to cut rates. Wednesday's jobs miss adds one piece to that picture. But one data point rarely changes the Fed's path on its own. The weeks ahead will be telling. More jobs data and inflation readings are on the way, and markets will be watching each one closely to judge how soon rate relief might actually arrive. If you follow the Dow-Nasdaq split as a signal, track the next jobs and inflation reports together. One soft print is noise. Two in a row starts to look like a trend. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.